Associate Dean for Faculty Development and Research at Case Western Law School, and I am so pleased to provide a special introduction for our first speaker to kick off this year's Case Downtown lecture series. You are probably aware that our speaker today, Lawrence Mitchell, is the Dean of Case Western Reserve University Law School. You may not be aware that he is also a highly respected and prolific corporate law scholar. Before we were able to lure him away to Case Western Reserve University, he was the Theodore Reinhardt Professor of Business Law at George Washington University Law School and the founding chair and executive director of the Center for Law, Economics, and Finance at GW, which is an interdisciplinary global think tank involving members of both the law and business school faculties at GW. He's the author of numerous books and articles on corporate governance, law, finance, financial history, and ethics. And this is a very rare opportunity to hear him speak about some of those things in public, in a public lecture or a large group lecture, I should say, where he won't be asking you all for money. So, okay, I'm happy to turn it over.
Thank you, Jesse. I think you just said I'm finally allowed out of the house in public. Thank you all for coming. So the title of the paper, Who Needs the Stock Market, conceals a number of issues about which I'll be speaking. And what I'd like to do is introduce them by talking a little bit about how I came to this topic in the first place. In 2001, the month that Enron went bankrupt, I published a book called Corporate Irresponsibility. That book was an examination of the ways in which public equity markets created incentives for managers to manage for the short term, and how it was that public equity markets had adverse effects on corporate behavior. To put it differently, I wasn't blaming boards, I was blaming shareholders. And that was an interesting position for me. The first decade of my scholarship was focused on fiduciary obligation. I started out as a very strong critic of corporate boards and have come through this course of 20 years of scholarship on the subject to have a very different view of why it is that things are not as they often should be. So after writing that book, which was premised really on modern realities, I started to wonder why. How did we get to the place where markets were so dominant? How did we get to the place where the incentives were so perverse? And so I turned to history. And I spent the next number of years writing a book called The Speculation Economy, which is a history of the development of the modern stock market. Subsequent to that book, which ends in 1919, I decided to do some empirical work to see what the market looked like in the ensuing years up to the present. And that's what I present today. So the question is, who needs the stock market? More precisely, the appropriate question is what functions the stock market performs in American society. We assume we know the answer. We assume the answer primarily is to finance business. But does it? And if it does, how well does it work? The question is important. The public equity markets are a central infrastructure in American economic and social life. They consume enormous amounts of our free cash. We spend billions of dollars regulating the market. And the market promotes broad and diffuse corporate governance through shareholding by institutions and individuals premised on the notion that somehow shareholders own the corporations. But what if we're wrong? What if the stock market does not in fact do what we suppose it to do? Such a conclusion would call into question the way we finance industrial productivity, the way we regulate markets, and even our entire shareholder-based system of corporate governance. I will show that, in fact, the market does not do what we suppose it to do. Public shareholders who have been predominant in the market for only 100 years have, during that period, taken more equity out of American public corporations than they have ever put in. While American corporations were primarily once financed from their own retained earnings and debt, they're now principally debt-financed, as earnings have completely disappeared from corporate coffers. Yet, shareholders continue to control corporate governance through the boards they create, leading to short-term management and threatening long-term sustainability. In other words, shareholders control the risk capital they don't create. The conclusion, which I'll explain in more detail, is that public shareholders should have few, if any, rights beyond those to receive information and sell their stock. So, why do we have public corporations? Well, the principal reason we have public corporations is to manufacture goods and provide services, in the process employing people and creating sustainable and transferable wealth from generation to generation. What do public shareholders contribute to this process? Nothing. It's a little bit of an overstatement. There's a qualification that I'll explain later in this talk. But essentially, in terms of finance, public shareholders contribute virtually nothing. So what rights should public shareholders have? They shouldn't. They should have the right to receive information and to exit their stock, to sell. In order to support an argument for shareholders' rights, we need to show that public shareholders make a meaningful contribution to economic growth, or at the very least don't hurt economic growth. Now, the common arguments for shareholders' rights reveal a paradox. The paradox is this. Microeconomic literature claims that shareholders are the residual risk bearers of American corporations. What this means is if the corporation fails, the shareholders are the last claimants to be able to collect on their investments. If nothing's left after other claims have been paid, shareholders get nothing. Based on this premise, the macroeconomic literature of development economics shows that financial institutions, including well-organized stock markets, promote industrial growth. The mechanisms through which they do this are information and risk sharing. In corporate governance terms, these translate into the following arguments, favoring shareholder rights. 1, shareholders are specialists in risk bearing because of the residual risk bearers of public corporations. Thus, they should have control rights. But what I will show is that shareholders only take market risks, not the risks of specific corporate failure in a market they create, and that market is not important to economic growth. Because shareholders are the residual risk bearers, they monitor management. But monitoring management is a consequence of their legal rights based on the premise that shareholders are residual risk bearers. As I will show, they're not. Therefore, their monitoring of management creates perverse incentives because their interests are not aligned with the interests of corporate and industrial growth. So with these arguments in mind, I'm going to turn to a very brief history of the American stock market to put this in context, a history I tell in much greater detail in my book, The Speculation Economy. The United States industrialized without a public stock market. The great corporations of the 19th century were almost entirely financed internally, with their own earnings, and with some debt. Standard Oil, which controlled almost 90% of the American petroleum industry by 1878, is one example. Carnegie Steel was organized as a partnership until it was folded into U.S. Steel in 1901. The railroads were created with government subsidies and debt. Banks financed with some equity, for reasons obviously to the nature of their business, but they were relatively closely held. By 1896, there were no more than 40 industrials traded on the New York Stock Exchange. Now, most of this industry was operated nationally or regionally, but it was contained locally. This was true even of the constituent corporations of the great trusts, the oil trusts, the sugar trusts, trusts in cotton oil, beef, lead, and trusts in some other industries. The reason is that the corporation laws of every state prohibited one corporation from owning stock in another corporation, making the holding company or large conglomerates impossible. For example, a railroad, which covered multi-state territory, would have to be separately incorporated in every state. So the track ends at the Missouri-Illinois border. You've got the Missouri Corporation covering the Missouri portion. You've got an Illinois Corporation covering the Illinois portion, and on out to Baltimore or Philadelphia or New York. That's a tough way to measure, to run a business. And almost every state had some form of antitrust law. And of course, in 1890, the Sherman Act was passed. But there was also an industrial problem that coexisted with this legal problem, and that was overbuilding and overcompetition. Despite the existence of the trusts, there was significant overbuilding of industry, led by the railroads, almost a third of which were bankrupt by 1890, because of price competition by multiple and often competing lines. The price competition among different corporations in the same industries led to very high failure rates, as a result of which consumers, which once enjoyed really good benefits of having competition and low pricing were served not at all because the businesses disappeared. This environment created enormous opportunity for the rationalization of American business if only the means to rationalize it could be found. So now enter two very different men, J.P. Morgan, of whom you've heard, of course, and James B. Dill, of whom you probably haven't. As to Morgan, say what you will of him, his biographers are pretty unanimous in identifying his motivating concern, besides, of course, the one for profit, he was raised by an investment banker, as being the rationalization of American industry. James B. Dill, on the other hand, a New Jersey corporate lawyer, was one of the most important inventors in American history. As I noted, state corporate law was written, and even more importantly, judicially interpreted, in such a way as to almost guarantee that business corporations would be relatively local and of relatively small size. The business of the corporation, as I said earlier, they're fractured among lots of corporations, so a big enterprise in an economic sense would be fractured in a legal sense. Between 1889 and 1896, Dill rewrote New Jersey corporate law in order to provide the tools that allowed for the legal creation of giant industrial corporations. Why New Jersey is an enormously colorful story in its own right, which I regrettably lack the time to tell here. It's kind of hilarious. I can assure you New Jersey was the most corrupt state in the United States from the beginning of the 19th century on, and it was as a function of that corruption that this law was adopted. But Dill made a number of changes in New Jersey corporate law. Two of them were key, and I'll mention a third. First, the new law permitted corporations to own stock in other corporations. This was a now familiar provision that permitted corporations to incorporate for any lawful purpose. Now, the first, it took till 1896 because the first iteration of this, courts which were very trust averse, would interpret it not to permit the holding of stock in other corporations. So to get it right, they finally had to say, including holding stock in other corporations, and we mean it. And so they finally got that, that refined. And this was huge. I mean, some of you will have had the experience, as I did as a very young associate, doing due diligence on a corporation that was incorporated in the 19th century. Those certificates of incorporations read like trust indentures, because you had to specify powers and purposes, and they go on for page after page after page, and you had to read that crap. In any event, that was eliminated with the provision with this new New Jersey law. The second key provision is that New Jersey corporations would be permitted to buy the assets or stock of other corporations using their own stock. A few states had similar provisions, and they'd been around for maybe a decade, a little bit more before New Jersey adopted them. But the kicker in New Jersey, and this took a few iterations before the courts actually got it right, according to the legislature too, was that in the absence of actual fraud, which was almost impossible to prove, especially given the very primitive state of the science of valuation then, in the absence of fraud, the determination of the value of the stock or assets by the board of directors was conclusive. So, look what we got. You can own the stock of a corporation as a corporation, and you can pay whatever you want for it using your own stock. Now, there's one other important provision, and that is where a corporation could do business. As I noted before, prior to New Jersey law, a corporation had to be local. You could own the assets in your state, but if you were going across state lines, you had to form another corporation in a different state to do it. And so this was, as I said, it was impossible. It drove Rockefeller crazy, which is why his lawyer invented the trust, which the state of Ohio first outlawed. I think it was the Standard Oil was an 1880s case. But New Jersey permitted its corporations to do business in any state, as long as the registered office of the corporation was in New Jersey. Having passed this law, having had the legislature pass the law, Mr. Dill and the New Jersey Secretary of State then became the controlling shareholders in the Corporation Trust Company, which was the home of all registered New Jersey corporations. And how did you have your registered office? You had a plaque on the wall. Standard Oil of New Jersey was a plaque on the wall in Trenton, New Jersey. And that was it. So, now that New Jersey did this, look what you could do. You could own stock through corporate holding companies. You could pay as much as you wanted for it, and nobody could really question you. And you could do business intrastate, multi-state. What these series of laws did, in effect, was replicate the outlawed trust form in corporate legal form. And that's basically the form of conglomerate or multi-business corporation that we know today. New Jersey's timing was perfect. As I said, 1896 was when the final revision was passed. In 1897, the U.S. came out of a severe 4-year depression and came out with a vengeance. There was a lot of free cash. There was a surplus of gold, there was a surplus of crops, there was a crop failure in Europe and in Russia, there was gold deficiency in England. So what you had was a rising middle class with huge amounts of free cash with no place to go. Right, in the 1890s, we don't have a lot of luxuries in American society, a lot of things you can just kind of throw your money away on, and we didn't have a market you could invest in. So what are you going to do with it? Well, Morgan figured it out. John D. Rockefeller jumped on this to create Standard Oil of New Jersey. Morgan created new U.S. Steel, but this is the beginning. Between 1897 and 1903, financiers combined more than 8,600 corporations, adding $20 billion of capitalization to the American economy, which in 2013 dollars is $470 billion of new capitalization in a period of about 6 years. Well, how'd they do it? Investment bankers formed holding companies under New Jersey law. The boards then issued preferred stock and common stock. And by the way, the only real stock traded up to this point, to the extent it was traded at all, was preferred stock. It's a whole other paper, a whole other story. And they would use that stock to buy the stock of other corporations. Many founding families and control groups were reluctant to sell. Carnegie was a famous holdout, and the only one of his partners who was smart enough to make Morgan pay him in bonds instead of stock. 3 years after U.S. Steel was formed, the stock tanked. Carnegie was still rich. But many were reluctant to sell the stock, and so, as is the case today, the buyer had to offer a significant premium in order to induce them to sell. But this was easy, because New Jersey law let you issue as much stock as you wanted to. So you'd simply print your own money. Typically, they were a little more careful than this. Typically, the preferred stock would represent the value of the assets, the book value or the market value of the assets. And I say that the science of valuation, as I said, was very primitive. And in the speculation economy, I have a very long chapter looking at finance theory at the time and valuation theory. But they tried to approximate the value of the assets with a preferred stock. Then they'd issue as much common stock as they needed to represent the premium, usually in equal amounts or more than equal amounts. And by the way, these were in the days of par value, so we're talking about $100 par value stock for the most part. The common stock was what is commonly referred to as watered stock, right? Stock in excess of the value of the par value or the value of the assets. And this became a whole huge problem as well. Garfield's son was the commissioner of a new agency Teddy Roosevelt created called the Corporations Commission. And he actually spent his mesh of his career working on this issue of watered stock as a United States Corporation Commissioner. So in any event, following the acquisitions of these companies, the holding company would then make a big public offering and dump the stock, mostly the common stock, sometimes some of the preferred stock, on the market. And now we have this new middle class with lots of money and nowhere to go, and they just sucked it up. It's actually astonishing to see how rapidly the changes occurred. You could read in 1900, 1901, the Wall Street Journal regularly telling you, don't invest in stock, it's too risky. It's speculative. By 1909, the Wall Street Journal was saying, stock, who cares? Buy it, it's great. Everyone should own some. And that's what started to happen. In any event, this was the creation of the modern stock market. The merger wave put the stock out there to be issued, to be bought. During World War II, The war bond drive actually stimulated huge investment in the market. By 1919, the market was so fully built that Woodrow Wilson, well, 1919, Woodrow Wilson was proposing modern securities regulation for the first time. Anyway, the subsequent story, of course, you know something about, the 1920s, the crash, the dormancy of the 40s and 50s. But the point I'm trying to make, to set the context for the data, is that the public equity markets were not created for financial reasons. That is, for the purpose of financing industry. They were created for a business reason, for combining corporations, but not for financing corporations. The wave of public offerings didn't raise a lot of cash. When I referred to that 472 billion capitalization before, that was the nominal value of the stock. That wasn't cash raised. So I will now turn to some data to support my conclusion that the public stock market has not characteristically financed industrial production. Let's see if I get this right. Okay. So first, and this is drawing on some secondary sources, if you look, you see that this chart shows the ratios of internal to total sources of finance for non-financial corporations from 1901 to 1956. Let me take that apart. Internal to total sources. What I'm trying to get at here, what this data gets at, is the extent to which corporations were internally funded versus externally funded. If you take a look, the range is about 55 to 60% in the early years, 1901 to 1930. During the 1934-39, obviously nobody was financing externally, so it was 98%, and still going through the low 60s through 1962. What is this internal funding source? This is retained earnings. This is the money that the corporation makes and puts aside. And by the way, dividend rates tended to be very high. This was an era in which people invested for dividends, not for capital gains. And up through the 1960s, a 40 or 50% distribution of dividends was quite common. The balance of the financing was primarily from various forms of debt. Long-term debt, short-term debt, accounts payable. But you see a very extraordinary, very high proportion of production was financed internally. Whoops, sorry. I'm really technologically challenged. Now, let's break it apart. That data that I just showed you was composite data compiled by a couple of economists in the 50s and 60s. I then took raw IRS balance sheet data from 1955 to 2007 and distilled that into linear time series demonstrating the different kinds of financing corporations use. By the way, IRS is really tough. We had to make 2 FOIA requests just to get this information that nobody had ever really looked at. So go figure. In any event, what we charted, and I say we, I had a couple of economics PhD students working with me. What we charted was, first, retained earnings versus external financing, okay? Note that in 1955, my number's a little different than the number you saw in those aggregate charts because I got at the information somewhat differently. 45% of corporate productivity was internally financed. Look at 203. You're down to 3%. Rising to about 11% in 2006, 2007. That's an extraordinary decline in retained earnings from the height of the Depression where it was 98%. So let's look at the next figure. This is capital versus external financing. Capital is capital plus paid in or capital surplus. What's capital paid in or capital surplus? That's the money paid for stock. It's the nominal value, it's the par value, plus the portion of the issuance that the board of directors designates as capital for non-par stock, or above the value of the par stock. So this is a proxy for equity, for external equity. Now, based on what I've said so far, you should think I'm a liar. Because what you see is you see equity rising from 1975. That's an anomaly. It's a statistical anomaly. The reason that equity is rising is because everything else is dropping. And I'll complete the proof of that when I show you federal flow of funds data in a few minutes, okay? But trust me for the moment that this is just a consequence of everything else dropping, and let's see everything else drop. Accounts payable, a lot of variance, but relatively stable line. Short-term debt, it goes up for a while, goes down for a while, converges on an average. Long-term debt decreases. Now look at the anomaly here. 1981, the year I graduated from law school, was the beginning of the huge going private movement, the beginning of huge amounts of leverage financing, leverage takeovers. But look at that. You see debt decrease, and you see it decrease rather significantly. Some of that is historical anomaly. It's another reason for that. Off-balance sheet financing. Just when the going private movement started, so did off-balance sheet financing. And it started with a vengeance. For example, Enron reported $10 billion of debt. It had $22 billion of debt. In 2006, 1/3 of productive capital investment was off-balance sheet leasing. I'm not even talking about off-balance sheet debt. It was off-balance sheet leasing. So this is a bit of a complicating factor. Since it's off-balance sheet, I can't fully prove it to you. But that decline in debt is as much a representation of where the debt's gone, hidden, than the disappearance of debt itself. So this is all, I'm not going to bother with this chart. This is everything together. So we've got two sets of data. The first set showing that through the mid-century, corporations were financed internally. We've got a second set of data that I've compiled, which shows that everything seemed to be going down, except equity. But there's a third set of data, and that is federal flow of funds data. This is a chart from 1945 to 2008, a graph to 2006, of net issuances of stock. Now look at this. And by the way, I didn't find this till after my data was compiled. I felt pretty good that this was confirmatory. It flatlines through about 79. Now look at this. During the principal decade of takeovers, stock goes down. Well, that makes sense, right? Because the takeovers remove the stock from the market. Then there's a blip up in the early 90s, and now during the dot-com boom, it goes down again. Well, that doesn't make any sense at all. And then it declines precipitously into about 2006. Well, what does this mean? So I thought for a while and figured, this is all corporations. I've been talking about industrial corporations. Let's separate industrials from financials. If we look at industrials, non-financials, which is industrials and farms, it's flatlined to almost completely negative all the way, with a tiny blip up, surprisingly, during the going private movement, and a huge drop down during the dot-com boom. Quite counterintuitive. Now let's look at financials. Look at that. Flatlining again until the late 70s, and then as the takeover boom starts, it soars. There's a blip down in the beginning of the dot-com boom, and then it goes right through the roof again. Now, that basically, what does the stock market finance? It finances finance. The public market finances the financial industry, which might be okay if the financial industry used that money to finance industry, but it doesn't. And we can talk about that as well. I should point out that this huge attraction of finance that this graph demonstrates has infected industrial corporations. In 2006, 30% of the profits of industrial corporations came from financial transactions. 48% of the assets on the books of non-financial corporations were financial assets. Now, you might say, well, there are a lot of accounts payable. No, actually, I looked. Accounts payable was a pretty small proportion of that. So, one last, do I have a slide on this? Yeah, one last thing I want to point out that helps to set the context for the rest of my talk is where the stock went. Industrial stock went. We saw that big drop in industrial stock. Look at the chart in stock buybacks. By the end of the third quarter of 2007, more than half of the S&P 500 had spent more money buying back their own stock than they'd spent investing in productive industrial equipment. And more in absolute dollars. The S&P 500 as a whole spent more in absolute dollars in dividends and stock buybacks, and by far the most of it was stock buybacks, than they spent in their own capital production. What do we know about stock buybacks? The one thing we know for sure about stock buybacks, they increase share price. And that is what I'm about to turn to, which is what I started with, the rights of public shareholders. The data very strongly suggest that American public equity holders have contributed little or nothing to the financing of productive activity, which alone should suggest that public shareholders' rights should be pretty limited. But the story is more complicated than that. I noted a paradox at the beginning of my talk. The paradox is that there's a vast body of macroeconomic literature in economic development that suggests, not without dispute, but fairly convincingly, that well-developed financial institutions, including stock markets, are significant drivers of economic growth. Public equity markets have received less attention than banks, but public equity markets are part of this story. So the question is why? Especially if I'm right that the public equity markets don't finance. Well, assuming that these markets are efficient, which is a rather large assumption made by the literature, markets overcome, informational asymmetries between corporate managers and the owners of capital. The information provided by the market, and notice the market's a precondition to information provided by the market, which is a question about the argument, induces capital suppliers, that is to say public shareholders, to invest in markets, facilitating the sharing of risk and providing liquidity for investors. It's the risk sharing that fuels economic growth. Owners of capital would not, so the argument goes, invest in stock if they were required to bear excessive risk, which would be the case if we didn't have a public market and they'd have to make large investments in only one or two corporations. But, so the argument goes, the opportunity to spread and share their risk by making small investments along with other small investors encourages flows of capital into the markets and thus, by hypothesis, corporate productivity. So the argument for shareholder rights follows as a matter of course. Because shareholders bear the residual risk of corporate failure, they should control corporate management through the mechanisms of board elections and shareholder voting on major corporate changes. But the data show that shareholders don't provide risk capital. So here's the paradox. If they don't provide risk capital, how can they be said to stimulate the economy by sharing risk? Now, you're all thinking, what's he talking about? Obviously, shareholders assume risk. We all know that investors in public equity markets can lose their money in a given corporation. So this seems to throw my conclusion into significant question. But the conclusion becomes clear once we ask the following question. If public shareholders, despite the data, remember it's not just my data, it's data going back to the turn of the century, if they in fact bear the loss of investing in corporations, how do they bear the loss? How do they assume the risk? Or to put it differently, what risks do they assume? The obvious answer to the how question is they do it by investing in stocks, directly or indirectly. But the obvious answer isn't so obvious. Well before Graham and Dodd's 1934 work on security analysis, the work that inspired Warren Buffett, it was well known, even early in the market, that investing your money in one or a few individual stocks was a really bad idea. And equally important, completely unnecessary, because the new market allowed for diversification. Now enter modern finance theory, which was developed at Stanford, Chicago, and MIT beginning in the 1940s. One of the most important developments in finance theory was portfolio theory developed by Nobel laureate Harry Markowitz. Markowitz set out not only to prove the importance and the correctness of portfolio investing, but to give it some evidence. So the basic insight is that you can diversify away your risk by investing in a portfolio of stocks rather than investing in a single stock. Now, it's somewhat inaccurate to say you can completely diversify away your risk because, of course, you can still lose money in any given corporation in your portfolio. But the argument goes, If you diversify well enough, the gains from the high performers will more than offset the losses from the low performers, and in effect, you've diversified away your risk. But this moves too quickly. For market webs observed, there are two different kinds of risks. One, unsystematic risk, is the well-known risk of investing in a particular corporation. Right? I mean, you could have a lousy business, you could be investing in an umbrella manufacturer and go through a decade of drought, you're going to lose your money. Those kinds of risks are unsystematic risks. It's this risk that you can diversify away by assembling a portfolio that balances variance with expected gain. If you diversify well, you will either achieve the highest return for a given level of risk or the least risk for a given return. But there's another kind of risk intrinsic to the market. This systematic risk includes things like the risk of inflation, economic cycles, major political events, government shutdowns, that sort of thing. You cannot diversify away this risk. It is systematic because it inheres in the market and it affects all stock. It's common to the performance of all public corporation stocks. So while you can diversify the risk of investing in a particular corporation, you can't get rid of risk entirely. The corollary that follows, and this is an important corollary, is that because you can diversify away the risk from investing in a particular corporation but not the market, the only risks for which issuing corporations have to compensate you is for the risk of investing in the market itself. Right? They don't have to compensate you for the risk of investing in that particular corporation because they know you can diversify it away. And in fact, Delaware law has, and American corporate law in general, has developed such that if you don't diversify away, you basically have no claims. So what this means is your rate of returning your portfolio should reflect market risk and market risk only. The reason that rates of return vary among different corporations is that the stock of each corporation reacts differently to market risk. For example, the stock of a corporation that's mature, relatively stable, fairly predictable earnings, fairly predictable sales, say a utility company, is less likely to swing wildly with the market than a corporation that's less mature, has a product with varying demand, unstable, or even no earnings, say a relatively new technology-based company or social media company like Amazon and Priceline in the early days, or Facebook, or as I'm sure we'll see, Twitter. So, enter the contribution of Nobel laureate William Sharpe, who developed the capital asset pricing model in the early 1960s. Sharpe showed how to build a portfolio that left you essentially with only market risk, and importantly, how to measure that risk. So your portfolio consists of stocks, and each stock has two kinds of return. Alpha return, which is the return intrinsic to that particular stock, and beta. Beta is a number which is the product of a regression analysis of the stock's historical price movement in relationship to the market. If you assemble a portfolio efficiently, alpha is 0. You've eliminated all the gains and all the risks from specific corporations, and you're left only with beta, the market risk of return. So, for example, a fully diversified portfolio, you're taking the risk of the market itself. This is the well-known argument: the safest way to invest is to invest in an index fund. In effect, you own the market. So the beta of that portfolio is 1. Market goes up a point, you get a point. Goes down a point, you go down a point. And that's it. Now, after all of this apparent diversion, we're ready to see why it is that public shareholders, despite the real risks they take, don't take risks that would justify their participation in corporate governance. If, as portfolio theory and CAPM show, the only risks shareholders take are the risks of the market, public shareholders have in effect created their own risks. They don't take the risk of investing in individual corporations. Those corporations don't compensate for shareholders for the risks they don't take. They only compensate shareholders for the risks they themselves create, assembled as the market. Thus, there is no meaningful sense in which shareholders are residual risk bearers in individual corporations. Rather, as the data show, creditors are. And so shareholder participation in corporate governance is unjustified. So the argument from development economics that public equity markets drive economic development because they facilitate risk-bearing falls apart in the face of microeconomic realities because the risk that shareholders bear is not related to financing industrial production, period. And why is this important? Public markets, as we all know, create powerful managerial incentives, and those incentives are maximized share price. The evidence is clear, and it's share price short term, I want to emphasize. The evidence is clear, and it's been clear from at least the 1990s, that stock price focus means short-term focus. Leaving aside shareholder elections, managerial tenure is directly related in most corporations to the way the stock performs. This has been exacerbated by institutional investor activism, which is almost always share price focused, high-speed trading, and perhaps most recently, the engagement of activist hedge funds, which go in, they do a hit and run, they maximize stock price, and they get out. Over the long term, the stock price drops. This explains why we saw the enormous boom in stock buybacks. Buybacks increase share prices, at least in the short term. It's why we see massive off-balance sheet leveraging, because the leveraging magnifies increases in share price, while off-balance sheet nature of it shields it from hitting earnings per share. It's why we saw the development of an off-balance sheet derivatives market that allowed corporations to keep debt off their balance sheets. It's why we saw dramatic retrenchment in research and development, the costs of which are immediate and the gains from which are very long-term. It's why managerial compensation in the form of stock options helps to fuel short-term stock price management. It's why we tend to see massive layoffs of workers before quarterly or annual announcements, and then subsequent rehiring. I don't have time fully to explain, all of which, by the way, is deleterious to the long-term sustainability of corporate business, right? This is a serious issue. I don't have time fully to explain it, but the process is facilitated by, and this is a whole other paper, the modern structure of corporate boards. So I said I started my career examining fiduciary duty, and I was a big fan of outside boards. And about 4 or 5 years ago, I published a paper with a complete about-face, very much in favor of inside boards. So the outside monitoring board, which we all have come to accept as the board, is a fairly recent development. Literature in the late 60s, early 70s, written by my friend Mel Eisenberg, then became incorporated into the ALI principles of corporate governance and Delaware jurisprudence that outside boards are what you need. They do better, they are not corrupt, they'll protect you. And Mel's intentions were good. I don't know about the Delaware Supreme Court. But the problem is that when you move from inside to outside directors, you lose expertise in the business. What expertise do you have? The ability to look at stock price. And that's what outside boards do. So outside boards started to become the dominant model in the 1980s, just when the takeover decade was beginning, just when off-balance sheet financing was beginning to develop. And so you, at the same time, had a board whose only real competence was to be able to focus on share price and short-term financial performance. So it's no accident that we see all of these things coming together to produce the same end result. So the implications are severe, not only because of it affects the long-term sustainability of American business. There's a question of intergenerational equity here. What we've done, what we're doing, is we've created a corporate system and a market with incentives that basically short future profits for current consumption. To explain that in real detail, and I'm going to stop in a couple of minutes so I have time for questions, I need to get into the sources of capital gains, which goes back to finance theory and my disproof of a Nobel laureate winning argument from the 1950s, which was true then but not true now. But in effect, what we've done is we've created a situation in which we're shorting the future. At the same time, we're creating the risk that American businesses aren't going to be sustainable. Yes, profitability recently has been pretty good, but take a look at the recession. Why did we have a significant recession after the market crash? Financing dried up, right? Banks weren't lending. But if you recall my first slide, corporations didn't have any retained earnings. We had a recession because they couldn't finance themselves. and because they'd come to rely entirely on outside financing. So the problems are really severe, and they're not, I think we sort of forestalled them with the bailouts of 2008. I think we would have been experiencing them now far more severely had those bailouts not occurred. At the same time, I kind of think had we allowed everything to crash, we would have been able to be in a position to seriously correct problems, which he didn't correct. Dodd-Frank doesn't correct much of anything. And I want to leave with one qualification to my argument. There is a question of why early-stage investors would put their money into corporations if we didn't have public equity markets to allow exit. That's another paper. And is, I'm sorry, I've thrown a lot into this because I wanted to give you the full context for the argument. And that's probably the best argument for the existence of a public equity market, is to provide exit for early stage investors. Just for a quick summary of my conclusions, there is a huge amount of empirical data that shows that exit by strategic merger is multiples of frequency the times of exit by IPO, and that exit by IPO is usually mispriced, inefficient, and hurts investors, whereas strategic merger exit has greater long-term sustainability. Again, this comes right back to the problem that motivates me, that drives me, which is the long-term sustainability of American industrial might. If strategic merger is a better guarantor of the preservation and development of our innovations than public offerings, then the exit argument tends to fall apart as well. It's still important. There are ways of dealing with it, but I'm going to stop now and take your questions. Yes?
You say that you say that the money from the IPOs is not going into industrial development. Then where is this money going from the IPOs? I thought I knew something about the market before I came here.
Well, no, clearly, there is money that goes from IPOs into industrial development, right? What I'm showing is that net, it's negative. But remember that a very significant proportion of IPO stock comes from founders and venture capitalists. And that's secondary, that's not primary, that's not going into corporations at all. In the early stage markets, the early part of the 19th century, early part of the 20th century, some capital was raised, but it was overwhelmed by the amount of secondary offerings and overwhelmed by the amount of financing by debt and retained earnings. So yes, of course money goes in. My argument is more of it goes out than comes in, and so net, corporations aren't benefiting significantly from a financing perspective.
Morning. When you're speaking about the committees and you're talking about the outside committees not having any interest in anything other than stock share price, how do you explain the having the audit committee, compensation committee, all the different committees of an outside board, if they're only functioning on share price only, as you're contending? How can you say that that's all they're looking at when you have all these different companies that are all these different committees that are established by the bylaws of any public company?
Right. So it's a bit of an overstatement, but not much. The audit committee, for what I said was not all they care about is stock price. Or maybe I said those words. All they can focus really on is share price and financial performance. The audit committee is about integrity, right? If you're not accurately financially reporting, your stock price is eventually going to tank. The audit committee is related directly to stock price. Compensation committees, my goodness. Let's talk about executive compensation, the rise of stock options in the 1980s and 1990s and 2000s, and the way in which short-term stock options completely perverted managerial incentives. In fact, I think it was by 2000, a 10% market correction would have wiped out the entire cash compensation of a Fortune 500 CEO because all the compensation was in stock. And it's short-term stock. So Ken Feinberg, following the crash, all of what you saw with the modifications to the executive compensation in the major banks was an attempt to make that compensation tied to long-term performance. So compensation committees actually have been part of the cause of this. Now, well-intentioned, right? Well, I'm not suggesting any evil motive for anything. Oh, totally well-intentioned. The theory is, if you give managers stock, their interests are going to be aligned with the stockholders, and therefore they're going to perform better, right? But the corporation is meant to be permanent. The average tenure of a CEO is 5 years. You make your payday yourself. Basically, and this is the unintended consequence, if you give somebody the license to make their own payday and show them how to do it, and the way to do it isn't in the best interest of the corporation, they're likely to do it. So if you have stock options that mature in a year or 2 years, it takes a long time. Warren Buffett famously wrote, nothing important happens in a quarter. Nothing important happens in a year, not if you look at the core business, right? One of the things I haven't talked about that I have other data on is the extraordinary rise in market volatility. I mean, turnover in 1960 was like 30%, 40%. Hit 80% in 1980. It's well over 130, 140% today, which means nobody's holding for the long term. You need to hold for a year to have long-term capital gains tax treatment. Nobody holds for that. I mean, some people, I do. Some people do. But what happened with executive compensation was you would say, we're going to strip you basically of most of your cash compensation. We're giving you a whole bunch of stock. You can exercise that 1 year, 2 years, 3 years from now. You're going to die someday, or you're going to get fired someday. And you're sitting there thinking, I really need to maximize my income. How do I do that? Let's cut the research and development budget. Or in extreme cases, let's lie on the financial statements. So I don't think that the fact that there are committees that look at specific dimensions of the business, it proves anything either way. And in fact, I can make the argument that most of those committees also are going to be stock price focused. And again, when I say this, I'm not attributing bad motives to outside directors. You don't have a lot of time. We have some outside directors sitting in here. You don't have a lot of time to look at the core business. And to I'm getting to a whole other paper. But when you have at least a number of insiders on the board, you have a way around the CEO. In the absence of insiders on the board, the CEO is the one controller of information, your source of information. What you want to do is you want to get behind that to the second-level managers who may or may not be willing to tell you that they don't like what the CEO is doing, but you have at least multiple sources of information. When the CEO controls your only source of information, that's a problem. Which is why I don't think outside boards are a good idea. Another reason I don't think outside boards are a good idea. Anyway, that's my answer.
There's a guy named Al Rappaport you may know that's similarly concerned as you are about the long-term prospects of American economy. And what Al has done is said he's developed a new method of accounting. He said accrual accounting is one of the principal agents of the kind of manipulation you've been talking about.
Yep.
And so he's developed a very sophisticated cash-based accounting method. And the neat thing is that as a practical matter, 3 votes from the SEC, including your friend Commissioner Paradis, I believe his name is, can change our accounting system from accrual to Al Rappaport's cash-based. What do you think of that? I
actually think cash-based accounting is a really good idea. In fact, suggested it in 2001 in corporate responsibility. There's another way of addressing this problem, which I've also been flogging to no huge avail, and that is shifting the way we tax corporate capital gains. One of the biggest drivers of this problem is volatility in stock price, or the ability to make stock price change rather rapidly. Our capital gains is a 2-stage on-off switch that occurs after a year. If, and it's a little bit more complex than probably would work, you looked industry by industry and determined what the long term was. And then you had a sliding scale of capital gains taxation, so you would tax the hell out of short-term trading, like a month, and maybe have tax forgiveness for long-term trading. You'd slow down the market, and you'd eliminate some of these incentives for short-term management. So if you took the auto industry, I happen to own some stock in Tesla. It makes me nervous as hell. I sold off my original position because I was getting really scared. But that's a Ford. Chrysler's about to do an IPO, right? The auto industry is a long-term industry. Say it's 10 years. So you can go through a 50% tax at 5 years to 0 tax if you held it for 10 years. A company like Twitter, I don't know, maybe that's 6 months. Maybe that's a year. I don't know. But you could have a similar kind of sliding scale capital gains tax for that industry. So what you would do is you'd build in a financial incentive not to trade quickly. And once you've done that, you've taken a lot of the steam out of the market. So either of those approaches, I think, or both of them combined, I mean, I like the idea of cash money because it's real. I happen to operate a business that's not a cash method business. And so I'm a big fan of that, but it's a good idea.
Okay, sort of a broader question comment. The title here is Why Do We Need a Stock Market? And I think you've made an interesting case on you don't need it for financing a productive activity. But I know those of us in the room who ever hope to retire, along with the rest of the world, as the defined benefits plan disappear, are looking to 401ks. And unless you're going to go into canned goods and ammo, you've got to have something else to put it in.
I love this question.
Proceed.
I love this question. So, in 1970, the federal government commissioned an economist to do a study of the securities markets, a bunch of economists. The first volume in the series, very famous Harvard economist, started out with a 100-page peroration with empirical data on what the United States economy would have looked like in the absence of a stock market in 1970. You know what he found? It would have looked just the same, with one exception. The extraordinary income equality of the 1940s and 1950s, which by 1970 had turned into dramatic income inequality and wealth inequality, which, as you know, has been only amplified since then, would not have existed. You wouldn't have needed it because the overall economic, relatively speaking, you wouldn't have needed big gains in the stock market to be able to retire. I'm in the same boat you are, right? But we wouldn't have, we'd have a much more equal economic system, and thus you wouldn't need those big amounts to retire, and you wouldn't need to be in the market to retire. It's actually, it's a footnote in one of my papers. I'll find it and send it to you. It's a fascinating, fascinating piece of analysis. And it's a total shock to me, right? I mean, obviously, I come to this from certain kinds of points of view. It would have been a point of view that would have been sympathetic to me. I would have been sympathetic too. But I never would have imagined that as the conclusion. I'm starting to read thinking, what would the economy look like? That's kind of different. That's kind of a good question. But it's a fascinating conclusion. I'm sure it's debatable, but it was pretty empirically solid. Oh, Nancy says we have to stop. Well, thank you for coming. I really appreciate it. And